let us start this fine week with the markets and your money, because this week could actually be a monster one for the record books. Here's why. If the S&P closes out this week higher, we will have a 10-week win streak. And my friends, that'll be the first time that has happened since December of 1985. That is right. The S&P has not gone up 10 weeks in a row since Rocky IV was the hot movie. Broken Wings by Mr. Mister was the #1 song, and IBM was the largest company in the entire world. Now, to get 10 weeks up in a row would be an incredible feat, nearly an impossible feat. The team at Jefferies notes that over the last 90 years, only 30% of 9-week win streaks have made it to the rarefied air of double digits. So, using the math, we have a 70% chance of keeping that 40-year record alive. But it's going to be a heck of a week to watch. And let's see how this whole thing ends up playing out. And talk about it to kick it off with Ben Emmons and David Waddell. Guys, welcome. Ben, quickly, you wrote this weekend that some of these market moves have been parabolic, meaning basically going straight up. I'm running out of superlatives. What do you make of this incredible run?
Hi, Brian. Yeah, this is incredible because each time these stocks move higher, you can tell from, let's say, take Micron as the key example of that today, just leaping just over $1,000. It looks more and more mathematically, I think, so parabolic, so straight up that there's not much chance anymore to reach at some point even higher highs because it should at some point actually correct, right? So this is a market where we're getting about 5% of the S&P in this sort of parabolic move, which I think at some point will just be unsustainable and corrects by itself.
Well, and now that Brian's laid out the history, I'm worried about this week.
I know, I jinxed it, didn't I?
Not so much jinxed it. You warned us that it would be highly unusual for us to be higher by Friday because we've almost never had a 10-week streak.
To be fair, Jefferies warned us. I just read their note.
David, what do you think about that?
Well, I think the right question to ask, and the reason why these things are going parabolic is this a cycle? Or is this structural? Is this secular? Should Micron be trading at 10x or should Micron be trading at 20x? And that's the question on the table.
Dell just doubled in a week.
Yeah, well, it used to be cyclical. Now it's not. We don't have cycles anymore, I guess, is what's happening in the market. And I mean, if you look at the 5-year earnings growth rate estimate for the analysts now, it's 23%. If you look at it across tech, it's 60%.
Wow, wait, for the coming 5 years? For the coming 5 years?
Yes, 56.6% is what analysts think tech companies are going to earn every single year for the next 5 years.
Every single year?
Yeah, there's no cycle anymore. If there's no cycle, we should go parabolic. The one warning I would say about things going parabolic is that gold and silver are stores of value. Gold went parabolic, now it's down 20%. Silver went parabolic, now it's down 40%. So it's the music's playing, everybody's dancing. It might be musical chairs, but we're not going to resolve that this week. I'm going with the over. I'm going higher this week.
Okay. Wow. Well, why not sell what you can to buy stocks, I guess, Ben? I mean, listen, either the earnings and guidance that we just came out of have changed the thinking, sort of to David's point, and or this is panic buying. And it, to me, having done this for a long time, maybe Kelly too, it's kind of starting to feel a little bit like panic buying. What do you think?
Yeah, that's, I think, exactly right, Brian. I think we're getting to a stage where people feel really pressured to buy these stocks as they go higher and higher. And although, you know, these are maybe the best performing stocks in the market currently, because given their incredible return, I mean, the risk that you're taking here currently at these levels, say you buy 5% of this stock and it does draw down, and that could be a pretty big burn in your portfolio. So I've been telling my clients, saying, like, if you really like this Micron team and it could become a larger company than it is right now, you don't want to buy 5%, you buy 0.5% and then let it draw down and then add to that weakness as it goes down, because this is just too steep of a climb. It's like, to you paraphrasing, Brian, the Rocky team, right, in 1985, he goes all the way up to the mountain, right, and screams Drago, and I think that's kind of where this Micron stock is heading, and that's when he has to climb down because he's out of breath.
Well, let's just talk, David, about the S&P 500, which might be just kind of the broad way to, it doesn't have to be about Micron, it doesn't even have to be about the triple Qs. You could just, I mean, look how we've gone from 5,000 2 years ago, 6, 7, 7,500. Now everyone's scrambling to raise their price targets for year end. And all of that seems predicated on incredible earnings growth. The earnings growth that we're living through is the only time it's ever happened before, as I understand it, either coming out of recession or in the late 90s. So it's been a while.
In the late 90s, if you looked at 95 to 2000, I think earnings were up about 60%. They're up 70% over the trailing 5 years now. So the analog is right. But what happened in the late 90s was we went through this moment. So if you index where we are in the cycle with ChatGPT and Netscape, you're 60% through. It is now June of 1998, right? Yeah. The market on the NASDAQ went up another 150%, 170% from there. So we went to 2000 to 5000, then we went back to 2000 by early 2001. So, the fundamentals right now are pretty analogous to where we were.
Well, but
it's a question of when we get into silly season.
A lot of those companies were unprofitable.
That's right.
A lot of those companies
were
were startups. They were fake.
I was at the NASDAQ. I reported on them.
But they were still real. Here's where the fake companies are now. They're in the private sector, right? I mean, you can take a private company now and grow it all the way up.
That's very fair, but keep going.
All the way up to $1 trillion, right, in total market cap. Once those market caps wash into the S&P 500, the PE is going to go from where it is now at 21, 22 to 24, 25, which is where we were.
The only pushback I wanted to offer to your whole thing about how there's no cycles anymore is...
Oh, no, I think there are.
Well, warning, you're saying the market is saying there's no cycles anymore, basically. But we spoke with Dave Cote last hour, who said, look, we're 40 years into what could be a 150-year period of the kind of this akin to the Industrial Revolution, the digital revolution. So while we all keep drawing analogies to the late 90s, but as we know, we never repeat things exactly the same way. So instead of the clock ticking down to 1999, what if we should be looking at this as how many more decades do we have to go?
I'm not worried about that as much. So the S&P equal weight, I love it, right? I mean, if you look at the sectors this past quarter, every sector made money. Like, I'm perfectly happy being up 10% right now on the year in the S&P equal weight and not 80% in the semiconductors, right? So I think there's going to be plenty of money to be made. I like SMID caps. That's worked too. Internationals are working. So there are plenty of ways to participate in the rally. The repricing that we just saw between the end of March and today, it's very exciting. But if you're up, 1,000% in a memory name over the last year, maybe consider taking a little off the table. That's all I'm saying.
Yeah, I mean, Ben, listen, the question I get from all of our wonderful viewers and listeners when they see me walking through the airport is, when is this going to end? When is this going to end? They're all obsessed with this idea that it's going to end, but everyone's too afraid to get off the bus before the bus stops, right? Nobody wants to be the first one off. I think this pace will end, but do you think this market run is going to end anytime soon?
No, I don't think that is the case, because, again, when we talk about a small part of the index that's really showing this frothy parabolic movement, the broad index is still performing just more than nicely trend and not extreme in any way. And if you look at the economic data, just take the ISM report this morning again, it shows all the strength underneath in the economy, and that's, I think, what's driving the broader market. But if you think of these particular names, is it going to end? I think, Brian, we could see some kind of a drawdown in some of these names pretty soon, just from profit taking in itself. But the market itself, I think, is in a healthy trend here, given the economy.
I mean, to that point, would I rather own today with fresh capital SpaceX or FedEx Freight, right? Which is spun out of FedEx at like half the valuation of its peers, right? Probably pays down a little bit of debt. There's enough economic tailwinds in the system. I think there are plenty of ways to make money in this market without having to go into companies trading at 100 times revenue.
FedEx Freight over SpaceX.
Yeah.
That should be
I'd rather have trucks than spaceships.
Yeah. Ben, what about you?
Yeah, I do echo that to an extent, although, SpaceX, let's see how it plays out, right? Because that's a phenomenal event, I think, in the next few weeks where, we're getting the first real mega cap. And, what will that do to rotation in the market? It will probably create some opportunity, I guess. But, to his point is that if this is industrial cycle, as you say, Kelly, like it's a longer term cycle, then you want to stick with the big blue chip names as part of your base of your portfolio. If in 1985 IBM was the biggest company, today is again in vogue. IBM, I think, would be one of my names I would pick here.
Oh, wow. All right. Well, how about that? From some of the brand new to some of the older guard, I guess. Like you said, happy to be in those areas as well. Thank you both. Really appreciate it. David Waddell, Ben Amons, for joining us this hour.